Yeah, Shobna, you can start.
All right. All right. Good afternoon, respected dignitaries, learned members, and their participants. On behalf of GST and Indirect Tax Committee of ICAI, I, CA Shobna Rochlani, warmly welcome you all. Today's insightful webinar on GST compliance in bank audit, key focus areas and practical insights. We are truly grateful to see you all participants for the topic that is extremely relevant in today's evolving compliance environment. Bank audits today are no longer limited to traditional financial verifications, right? So today's session is designed to provide you exactly practical clarity, real life insights, and also actionable knowledge. It is now my privilege to invite CA Rajendra Kumar P, our Vice Chairman of GST and Indirect Taxes Committee of ICAI to deliver the opening remarks. Sir has been actively contributing towards strengthening GST awareness and professional excellence. Sir, we look forward for your valuable words.
Thank you very much. Very honorable speakers today for this webinar. The chairman of the GST and Indirect Taxes Committee, sitting to my left, Honorable Umesh Sharma ji. Very esteemed participants. Your committee, one of the most loved committees of ICAI and one of the most important committees of the nation, the GST and Indirect Taxes Committee, has been in the forefront in all initiatives in GST. Under the dynamic leadership of our chairman, CA Umesh Sharma ji, whom all of you are aware, is extremely dedicated and has a strong foothold in this subject. We have been conducting regular webinars for the benefit of members, and today's program is also one such program where we bring you a contemporary topic of very important relevance for the nation and for the profession. Thanks to Umesh ji for actually conceiving this particular topic. It is his idea. And also to the esteemed speakers who have actually shared their valuable time to come here and guide all the members. In fact, we in the GST and Indirect Taxes Committee are taking long strides. Long strides in arming, in equipping every stakeholder on this very important consumption tax. Our chairman has a dream and desire to ensure that anything that is relevant is provided to the member. For example, the GSTAT. Very recently, we had a meeting with various authorities in GSTAT as well as GST Council, whereby we are able to impress upon them to reach the public. In fact, they have come to us and said that they need the support of ICI for the purposes of conducting various events and seminars so that we handhold the stakeholders, especially the department people. So friends, GST committee is not only for members, not only for the government department, but for the entire stakeholders who have an impact on this very, very important consumption tax. We are always available for all suggestions. Our committee secretariat, under the leadership of CA Smita Mishra, has always been proactive. Any mail that you send is being read by us, and wherever it is necessary, we take the same to the government under the leadership of our chairman. So thank you very much. Over to my chairman for further pleasantries.
Thank you for your insightful opening remarks, sir. Now it's my honor to invite a person who needs no introduction, CA Umesh Sharma, sir, our AI guru, Chairman of GST and Indirect Tax Committee of ICAI, to deliver a welcome address. We request you to kindly address the gathering, sir.
Thank you, Shobna, and thank you, Anandji, for your acceptance for being a speaker for this important topic and very special topic, that is GST in banking sector. We all know it's a very specialized area. There are very few dealers
who are registered under this banking sector across India. So the knowledge which Anandji has possessed is a very special knowledge. He is a rare gem who will be delivering this subject. And right now, our many members are going through bank audits, statutory branch audits, and statutory bank audits also, or concurrent audits also they do. So in that, this particular subject will help them to close their bank audits assignment as soon as and perfect. So friends, welcome you all. And as rightly pointed out by our passionate chairman, our RK sir of this committee. So I am the chairman, but he is a passionate chairman of this committee. And we meet different authorities regularly under his guidance. As told by sir, we have already met GSTAT people, then GST Council people. And friends, be ready for the 3 days workshop on the GSTAT practice. We have named that workshop as a G-Start. So it's a GST art, or you can say a G-Start. So it's adjudication, representation, and T represent for tribunal practice. So GST and ART. So please join that workshop. There will be outreach programs also at 48 locations of the different GST tribunal. And also we are coming up with the industry specific publication up to 10th of April. The invitation is open. Please check your emails, please check your WhatsApp, or visit our GST website. And you can also become a writer or a contributor for one of the subject. 14 subjects are there. So looking forward for your response. We already has got a good response, but still we are waiting for other people, or even senior persons can join as a reviewer of that book. So there can be a writer and there can be a reviewer. And we welcome your suggestions, your comments on regular basis. So our WhatsApp numbers are there, our group is there, and even you can scan the QR code which is given on your today's program banner. If you are registered for this today's program, then there is a QR code also on that JPG image of the banner, where you get a WhatsApp channel of GST and Indirect Tax Committee, where you will get regular update. We know that we are sending emails, we are sending SMS, but still we are also implementing that WhatsApp channel. So please join that. Our Twitter is also there, and lot of new activities are planned in this year. GST symposium will be there, outreach programs are there, and regular webinars, seminars are already there. So we are looking forward your suggestions for creative inputs and positive inputs, whatever it may be. We are there in GST in all aspects, at GSTN level, at a council level, at a state level, at a central level. Please let us know your suggestions and we will implement. So with these words, thanks all the participants for joining. Happy bank auditing seasons to you. Those who are lucky, those who are fortunate to got that bank audit assignment. Otherwise also, this is a good subject for cooperative banks also, for the RRBs also. So please stay connected. Over to you, Shobna. Thank you.
All right. Thank you for those exciting news, sir. So now it's my privilege to introduce our esteemed speaker for the session, CA Anand Arun Desai, sir, a fellow chartered accountant, a practicing professional since 2004. He is third generation chartered accountant and a partner at Anand Desai and Associates, as well as NM Raji and Company. He specialized in indirect taxation, direct taxation, litigation, and advisory with a deep expertise in banking and construction sectors. He has been actively involved in implementations for banking institutions, and also worked with leading organizations such as State Bank of India, Central Bank of India, and many more. He has been also appointed as special auditor under section 66 of CGST Act and contributed as speaker in many sessions. With such a vast experience and practical exposure, we are confident that today's session will be extremely insightful for all of us. So, we honored to invite you, CA Anand Desai sir, to take over the session and share the valuable insights. Over to you, sir.
Thank you, madam, for the kind introduction. My special thanks to the chairman and the vice chairman of the Indirect Tax Committee for having their opening remarks and having said such kind words about me. Madam, today's session that has been allotted to me is maybe around now it is about 1 hour and 45 minutes that I have to speak on this topic of GST compliance in bank audit, key focus areas and practical insights. I have my PPT. I'll be just sharing the screen. Just a small excuse from my side that this PPT is a vast PPT of about 128 slides. I'm trying to cover each and every aspect that an auditor may face in course of his audit of a bank unit, be it a branch or be it a bank as a whole. But I have tried to cover each and every part of the bank audit with the practical scenarios which an auditor may face at the end. So I may be running through fast in some of the slides by just making a passing remarks because those slides can be self-explanatory or can be read by the participants. Just pardon me for that. Otherwise, I will start my session and I'll be just sharing the screen just now. Yeah. Madam, is it visible now?
Yeah, it is.
Yeah. So, GST compliance in bank audit, key focus areas and practical insights. Just pardon me for a minute. So in today's session, I will be covering these topics. What is banking? Nature and classification of activities undertaken in banking sector. How banking sector is different from other businesses. Deferred revenue and the treatment under GST. Reimbursement and treatments in GST. Penal interest and foreclosure. So what are the treatments of GST pertaining to penal interest and foreclosure charges? Then what is the issue going around relating to the business verticals set up by the banks, interbranch transactions, related party transactions, the implication of reverse charge on various activities undertaken by the bank or the expenses undertaken by the bank, some input tax credit things, the ISD concept which has become mandatory from 1st of April of 2025, then the GST returns compliances and common issues faced by the banks. So first to start with, what is banking? See, banking has been defined under the Banking Regulation Act, and it means that it is a business of accepting deposits and for the purposes of lending. Banking is not defined under the GST Act, but we draw the definition of the banking from the erstwhile Service Tax Act and Section 6512 of the Service Tax Act. gives a complete definition of banking and financial services, and it's a very exhaustive definition. It not only restricts to the activities of borrowing and lending, but also includes activities like leasing, merchant banking services, securities and foreign exchange services, asset management, advisory, and so on and so forth. As far as the banks are concerned, they deal with monetary or money aspects. That is why we call them as financial institutions, because they deal with finances. As the definition says, it's a function of borrowing for the purposes of lending. So the major incomes of the bank, if we see any financial statement or the profit and loss account of a bank, about 90 to 95% of the income of a bank comprise of interest income. Interest income can be from various sources, that is overdraft, loans, so many and so forth. I will not be dealing with those things because these are with the common knowledge of all the participants. So major income of a bank is from interest. Other incomes of the banks are from the various charges or the commissions that they charge for the various services. Then profit and loss on sale of investments, profit and loss on sale of land, buildings, other assets, income from financial leases and investment incomes, because bank also invest in various instruments, and interest therefrom also happens to be a source of income. As far as the banking part is concerned, as far as the GST part is concerned, the major income of the bank is interest income. It is an exempt income, notification 12 by 2027 or 12 by 2017. And the other incomes, commission, exchange, brokerages, etc., are taxable incomes. Now, what I have done in the next slide is that I have tried to categorize the various banking related services under the SSE codes. So these are the list of various services which generally a bank renders, and that has been classified under various heads, under various SSE codes. Yeah. So I'll not be dealing with this. It is just for reference that I have given this. So this will help for the classification of various services, because the classification as per the SSE code will also help to derive the rate applicable for that particular service to be charged. Now, how banking business is different from other businesses. So what I have tried to do here is I have tried to explain the aspects of the banking business. What is the nature of banking business? Method of accounting, what is important to understand a financial statement of the bank. That is, what are the incomes, what are the expenses, what are the assets, what are the liabilities, and how they are to be derived or read. Then what are the set of books of accounts that generally a bank maintains, types of audit, compliances with input tax credit rules, GST applicabilities on various banking incomes, and additional points. So to start with, nature of business. So banking happens to be a very complex business because it deals with financial transactions of borrowing and lending. At the same time, first happens the borrowing part and then happens the lending part. Whenever a bank borrows money, generally the borrowing of the money is from the depositors. The depositors are the customers of the bank who open accounts in bank. It may be a saving account or it may be a current account. The monies are kept with the bank and bank needs to deploy that for its businesses. So there comes my lending operations. The money that the bank collects, it is either from the deposits or it is either from the capital or the equity from the shareholders, etc. This money needs to be deployed by the bank in various instruments or in various formats. These various instruments or formats are all listed. They are as per the RBI guidelines. A majority of the investment of the bank happens in their treasury operations. So treasury operations are those operations where the money of the bank is invested in order to get a return in such a manner that the return that the bank receives is commensurate enough in order to pay the interest, or that is the outflow, or that outflow for the lending activity, as well as meet the administrative expenses, derive profits from where the shareholders can be returned. So treasury happens to be a very important aspect of the banking institution. So treasury operations are very important. So likewise, the banking is a very complex structure. It includes very high amount of volume of transactions and a lot of regulatory compliances from the RBI, etc. Whereas if compared to other businesses or business structures, it is simpler in transactions, it is industry specific, and it has varied business models. Varied business model means other sectors operate under different business models such as B2B, B2C, or hybrid model impacting the GST treatment of transactions. Method of accounting. mm, Generally, the banks follow the accrual system of accounting. Banks typically follow the accrual system and record the financial transaction, including interest, incomes, and loan provisioning, requiring the auditors to understand and apply the GST rules to these accounting practices. Inventory accounting, when a bank repossesses an asset, because if a loan goes bad and the loan cannot be repaid by the borrower, then bank has to repossess the underlying asset based on which the loan was given. Such repossessed assets form a part of the bank's inventory. Likewise, bank also has their own inventories in form of stamps, documents, etc. There are a lot of reporting and regulatory compliances which are applicable from the bank, which are different and separate from the other businesses. Generally, other businesses, they can either follow a mercantile system or a cash system of accounting. Inventory controls are specific to the nature of the business that is concerned. For example, in the case of a trading entity, the inventory controls are different. In case of a manufacturing entity, it may be different. So, likewise, such types of requirements are not there in the banking industry. Now, here comes a very important part to understand the financial statements of the banking industry or the banking company. Account mapping and its significance in audit and taxation. Uh, Believe me, if I take up a financial statement of a banking company, it comprises of the balance sheet and the profit and loss, and I take up the GST returns of a bank, and I just try to compare the figures in the GST returns with any trial balance or with the financial statement, be it a profit and loss account or a balance sheet. I will never get or I will never arrive at a reconciliation from a single view of it or by referring to it. Because the important aspect in banking is number one, that in case of banking, the accounts are mapped. There is something called as there are four types of mappings: CGL, BGL mapping, PL, and NL. CGLs are the control general ledgers. They are at the head office level. The BGLs are at the branch level. PL are the codes which are linked to the profit and loss, and NL are the nominal ledgers which are linked with the balance sheet. So in case of banking, all the accounts are prepared in a coded format. So there are codes which are given for every account. Certain accounts which are maintained at the branch level, BGL codes, control ledger accounts at a central level, profit and loss, PL accounts, and NL accounts. These accounts are coded. Now, in case if I am a branch or I'm a branch auditor and I'm doing the audit of that particular branch, what is important for me is the BGL, that is the branch ledger accounts. That branch ledger accounts will give me the information about the branch profitability. Now, these branch ledger accounts are consolidated into the central ledger accounts at the head office level or at the zonal and then at the head office level. That will give the overall picture of the financial statement of the bank. Now, in these BGLs and CGLs, it is important to understand what are the taxable aspects, what are the exempt aspects, what are the non-GST aspects, and how they are to be read in consolidation of the financial statement. Without the knowledge of these consolidations, it is very difficult to arrive at the reconciliation of the GSTR returns with the financial statements. Many a times what happens is the GST department, they come and then they just try to compare the GSTR returns with the financial statement, and they arrive at obnoxious findings. and they arrive at absolutely wrong reconciliation. It is very important to explain them how the BGLs, CGLs, NLs, and the GLs are coded and reflected in deriving the taxable, the exempt, and the non GST incomes. Methods of accounting. Methods of accounting generally, the in case of our normal businesses, we find softwares like Tally or QuickBooks or SAPs, etc., where the entire accounting is done. Whereas in case of banking companies, it is mostly the core banking softwares which the bank derives. Here, all the accounts are coded in this software, and then the data integration takes place, and it is done through all automated tools. Books of accounts. In case of other banking sectors, we have normal sales, purchase register, cash books, expenses, etc. Whereas in case of a banking sector, it is generally the ledgers for financial transaction, general ledgers, subsidiary books, and the registers for recording of invoices, etc. So we don't find the traditional purchase sales registers or our ledger books or expense register as fine as seen in the regular businesses. Whereas in the case of banking businesses, various banks use separate tools for recording their expenses, for reconciliation of the ITC, and then pushing back to the core banking softwares. Types of audits. We have statutory audits in banking sector. We have internal audits, concurrent audits, revenue audit, RBI audits. Lots and lots more audits in banking sector by the regulators in order to ensure proper compliance. Whereas such audits are a number of audits in other businesses are lesser. We have statutory, internal, and cost audits in our regular businesses. Compliances with input tax credit. Banks generally follow Rule 38 for the for the purpose of reversals. For purpose of reconciliations, they follow Rule 36. And as far as the other businesses are concerned, there is a specific Rule 17.2 which requires the pro rata reversal of ITC. As far as banking sector is concerned, they follow Rule 17.4, which talks about a reversal of 50% of the ITC claimed by the bank. Rate of GST applicable, mostly it is 18%, whereas in other businesses it may be 5%, 18%, now 12% the rate has been removed. Types of incomes in banking sector. As I said, there are taxable incomes, there are exempt incomes, and there are non-GST incomes. What I have tried to do here in my presentation is I have given the list of various incomes that are generated in a banking company, and then classify it according to its taxability, exempt nature, and non-GST nature. So these are the list of basically all the commissions, discount, charges, fees which are charged by bank for its services are taxable. Interest income obviously is an exempt income. So there are interest on various types of products, term loans, CC loans, OD loans, capital, packing credit, etc. All these forms are part of exempt income. Then income from repos and reverse repos. This is borrowing and lending by the bank from the central bank, the interest charge for that. Income from future contracts without delivery, commercial papers, CBLO transaction. These are all list of exempt incomes in case of banks. So these are the notifications that are pertaining to these exempt incomes. I thought it may be useful for the participants to refer it on some later date. Here what I have done is I have done the analysis of the headwise incomes earned by the bank, and then try to do an analysis pertaining to its taxability, the reasoning, etc., the place of supply, or some kind of notification pertaining to the exemption, giving reference to that. So this is pertaining to interest, which is entry number 28 of notification 9/17, and it is not taxable. This is pertaining to fees and provision and processing fees. These are taxable. Commission is also taxable. Brokerage income is also taxable. Agency charges taxable. Account maintenance charges, locker rents, etc. taxable. Convenience fees, yes, it is taxable, but yes, there is a there is a notification which says that GST will not be applicable to any person transacting in relation to settlement of an account up to INR 200 or 2000 in a single transaction through credit card or debit card. I have dealt with it in separately also. This is pertaining to the MITI incentive. Consideration for providing purchase or sale of foreign currency. Per se, buying and selling of foreign currency is not taxable because it happens to be a transaction in money. But the service of conversion of this currency upon buying and selling happens to be a taxable transaction, and the valuation thereof takes place as per Rule 33, and the tax has to be paid thereon. We call it as FCCT, that is Foreign Currency Conversion Tax. So now this is relating to the incentives that I was saying, that there is a limit of 2000 rupees and below 2000 it is not taxable. So this is pertaining to the Ministry of Electronics and Information Technology, which has given this exemption by circular number 190 stroke 02 by 2023. The clarification gives an exemption from GST to the MITI incentives received by the bank. These all are worked out and calculated by this government department, and they are sent to the bank. If it is a MITI incentive, then it is exempt from GST. Now from here I come to the conceptual level of our discussions for today. Deferred revenue and GST treatment. So this is a concept, deferred revenue, because why I was saying this, sorry, why I have taken up these issues is that as far as a bank is concerned, the income that is received by the bank is taxable, but the method in which it is accounted for by the bank may not immediately give an impression about the taxability of that income. To make it more simple in my explanation is that, for example, there is a BG commission, that is a bank guarantee commission. The bank guarantee may be given for a period of 3 years. I'll give you a simple example that a commission for the bank guarantee is 90,000 rupees. Commission for the bank guarantee is 90,000 rupees. And at the time of giving the bank guarantee itself, the entire commission is recovered by the bank from the customer. This 90,000 is recovered from the bank, and whatever is applicable for that particular financial year or for that particular quarter is only recognized as the income in the profit and loss account. So in our example, if 90,000 rupees is the total bank guarantee commission applicable for 3 years, 1 year commission is 30,000 rupees. So for first quarter, the amount would be 7,500 rupees. So in the first quarter, what the bank will do is they will recognize 7,500 rupees as the commission, and the balance amount will be recognized in the balance sheet on the liability side. Come the second quarter, another 7,500, third quarter, another 7,500, and fourth quarter, the entire 30,000 rupees. So now here, as far as my GST treatment goes, GST is liable to be paid upon receipt or accrual, whichever is earlier. In this case, the receipt was earlier and we received the entire 90,000 rupees, whereas the accrual has taken place depending upon the period involved, that was the quarter wise. So here what happened was, in my financial, only 30,000 was recognized as the income for the particular year and 60,000 was recognized as the liability. Whereas in my GST returns, in the first month itself, upon receipt of 90,000, the entire tax at 18% was paid and the liability was discharged. Now tomorrow, if a GST auditor or the departmental person tries to reconcile this 30,000 in the financial statement with the 90,000 that has been reported in the GST returns, then in that case it is very important for the auditor to explain him the concept of deferred revenue recognition, because many of the banks have started following Ind AS. So accordingly, as per Ind AS 109, the incomes and the expenses are recognized depending upon the period involved, and hence this reconciliation becomes very, very important. I just explained that. I am not going to go through everything here, but the basic concept is the same which I have explained now. So that deferred revenue income recognition as per my financials and as per my GST return needs to be explained to the department, and also needs to be explained to the auditors in order for proper compliance. Similarly, the next issue I have taken up is reimbursements and their treatments under GST. Reimbursements, as we all know, it refers to the repayment of money spent by a person. In a business transaction, this usually happens when a supplier incurs expenses on behalf of the recipient who is supposed to incur the said expenses. It is simple that I reimburse you. I make an expenditure on your behalf or you pay it back to me. That is a simple thing to understand for reimbursement. So whether reimbursements are taxable, yes, as per the erstwhile Service Tax Act also, reimbursement were taxable. Now, as far as the GST law is concerned, my value of supply, section 15 talks about section 15(2)(b) to be precise. It tells that any amount that a supplier is liable to pay in relation to supply, but which has been incurred by the recipient of supply and not included in the price actually paid, has to be added to the price. Also, section 15(2)(c) talks of all the incidental expenses, etc., which if paid by the recipient, if paid by the supplier, needs to be reimbursed by the recipient. That is there. Now, there is a specific rule relating to reimbursement, that is rule 33. Now, whether all reimbursements are taxable, the answer is no. All reimbursements are not taxable. Reimbursements which fall under the category of pure agent are not taxable. Other reimbursements are taxable. So what is exactly this pure agent? So Rule 33 tells us, notwithstanding anything contained in the provisions of the chapter, expenditure or cost incurred by the supplier as a pure agent of the recipient of supply shall be excluded from the value of the supply if all the following conditions are satisfied. So what are those four conditions? That rather three conditions, and then pure agents, for explanation of pure agent there are four conditions. So what are the three conditions? That supplier acts as a pure agent of the recipient of supply when he makes the payment to third party on authorization by such recipient. So he makes a payment to the third party on authorization by the recipient. Payment made by the pure agent on behalf of the recipient of supply has been separately indicated. It has to be separately indicated in the invoice. And the supplies procured by the pure agent from the third party as a pure agent of recipient of supply are in addition to the services. So the reimbursement has to be for something addition, not for the same part. Okay. Explanation for the purpose of this rule: the expression pure agent means, who is a pure agent? He is a person who enters into a contractual agreement and he acts as a pure agent to incur the expenditure in course of supply of goods and or services, or of both. Neither intends to hold nor holds any title to the goods or services, or both, so procured or supplied as a pure agent of the recipient of supply. Does not use for his own interests such goods or services so procured. These, point number C, is very important. Does not use for his own interest such goods or services so procured, and he receives only actual amount incurred to procure such goods or services in addition to the amount received for supply he provides on his own account. Why I said that does not use for his own interest such goods or services so procured? We all see that in banks there are loan documents. These loan documents are stamped and then used by the bank for the purposes of their loans. Now here, many a times it is seen that nowadays, rather it was not earlier, but nowadays it is seen many a times that the banks ask the customers to do the franking and submit the forms, etc. And then those forms are used in the course, or then they are used in the course of the disbursement of loans, etc. Now here, does not use for his own interest such goods or services. So when the stamps are franked or documents are stamped or franked by the customer, and such documents are used by the bank, then in that case, definitely the loan document gets a more legal weightage when the stamps are refused, rather they become enforceable. So if this cost, which is to be incurred by the bank, is incurred by the customer, it needs to be added to the value of supply, and then GST needs to be discharged. So that was the reason why I made this point. I highlighted this point. So these are certain issues under the context of reimbursement. I will skip that because by reading, rather they have these points have been explained with either the advance ruling with the judgments of the advance ruling authority or some case laws, etc. So I will not be going through this. I'll just skip this. Now we come to the important aspect of income earned by the bank in form of liquidated damages, penal interest charges, and foreclosures. Now, this was a disputed point for a long time. Lot many banks had got notices on this, whether GST needs to be paid on liquidated damages, penal interest, etc. The GST in the erstwhile service tax law, there was a judgment of Repco Finance from the Madras High Court, which says that no service tax needs to be paid on foreclosure charges, because these are financial charges, and the same context has also been imported in the GST law. Rather, Circular 178 talks about it very clearly. Some banks similarly charge prepayment charges, etc. The concept here to understand is why prepayment, why foreclosure charges. As I said, banking is a business of borrowing for the purposes of lending. Banks borrow money from the depositors and lend it to the borrowers. So tomorrow, if a borrower, if the money is lent to a borrower for a period of 5 years, and the borrower comes to the bank with a of intention to foreclose the loan, so the bank will oblige him by foreclosing the loan. He will close the loan at an earlier period. But at the same time, can the bank foreclose its contract with the depositors? The answer is no, because there the depositor has deposited money with the bank maybe for 3 years, 4 years, 5 years, and bank is committed to honor that kind of a promise. And that is why here, by accepting a floor closure from a borrower, bank cannot close or foreclose a deposit. In order to bridge this gap or to manage this money to be paid to the for the foreclosure or towards the foreclosure to the borrower, bank has to manage the funds or make some arrangement where it may incur some expenses, and this foreclosure charges, etc., are taken for that money that the bank has to arrange in order to pay out to the depositor at the time of completion of the contract. So these are all transactions in money, and hence there will be no liability to pay GST. Another thing that the GST that the CBIC has come out with is that they have clarified that if the main transaction is exempt, any kind, or the consideration for the main transaction is exempt, then any kind of penal charges, additional charges, foreclosure charges pertaining to such contract or to such transaction will also be exempt. Here, what is taxable under GST is a consideration. So, under GST, if the consideration is in the course of a taxable supply, then it will be taxable. But as far as foreclosure charges, etc., these are generally, number one, to deter the customer from not closing it, or any kind of penal charges to deter the customer from not doing or for not making a wrongdoing. So a condition of a contract cannot be equated with a consideration that is taxable under the law. So that is the crux of these findings. So there is a Bayana Builders judgment also, and there is a notification. I have reproduced it for the reference. Another aspect is the income from sale of repossessed assets. Banks lend money, and in as a security against those loans, banks take securities by way of machinery or maybe other assets, etc. If the loan goes bad, then the underlying asset is repossessed. This happens in case of vehicle loans, in case of term loans, etc., where some machinery or some vehicles are considered as a security against the loans. So once the assets are repossessed, so what is repossessed? That in case that the loan goes bad, the asset is taken and then it is auctioned or sold, it is sold, and the value from that sale is used in order to square off the outstanding loans. So in case of repossessed assets, there is a valuation mechanism which is prescribed under Rule 32.5, under proviso to Rule 32.5, which talks about how the valuation has to be done in case of repossessed assets. Now, if the asset is within 5 years, then in that case, 5% for every quarter, 5% for every quarter depreciation has been charged, and it has to be calculated, compare with the book value. And if the sale value is more than that, on the differential value, the tax needs to be paid at the rate which is applicable for that instant asset. So this is as far as the repossessed assets is concerned. Then card fees, penalty charges, interest, etc. Many of the banks have the vertical of credit cards, etc. So the credit card activity generates card fees, charges, interest, penalty. Credit card charges, etc., issuance charges, other convenience fees, etc., are all taxable services. Only the different point here is that we learned that in case of interest income from loans, etc., it happens to be an exempt income, and there is no GST applicable on interest. Unlike so in credit cards, the interest on credit cards is taxable under GST. It is not covered by the notification 12 by 2007. The exemption from the levy of GST on interest specifically excludes interest charge on outstanding credit cards. So the credit card interest is a taxable component under GST, unlike interest from on other loan products. Similarly, penalties, etc., are also taxable under GST in case of credit cards. Business verticals. Now, this is a very important and a burning issue in many of the banks currently. Business vertical means it's a distinguishable component of an enterprise that is engaged in the supply of individual goods or services, or a group of related goods or services which are subject to risk and returns that are different from those of other business verticals. These verticals will have a different nature of goods or services. The nature of production process may be different. Type or class of customers which is dealt by the vertical are different. The methods used to distribute may be different. Nature of regulatory environment also can be different. Now, why banks are going for a separate business vertical? Generally in case of banking, they are covered under section 17(4) for the claim of ITC, where they're eligible to reverse 50% and avail 15%, 50%. If the banks form a separate vertical, or they get registered for that separate activity, because now this business vertical concept no longer exists in 2017, because it has been amended or changed by the concept of place of business. So, but just to understand what the concept is, I have kept the name as business vertical. So generally, the activities undertaken by the bank, which are different from the activities of borrowing for the purposes of lending, these are activities of bullion business where the skill set itself is different. Bank purchases the bullion; it may be in form of gold, it may be in form of precious stones, or whatever form it is, and then it is sold to the traders who make ornaments or who make whatever articles from that. Then there is another line of business called as digital banking. Basically, digital banking, how it is different from the main banking. Digital banking, it helps to facilitate online remittances or transactions of online nature between a customer of a bank and some outside service provider or the recipient. So here, digital banking helps in facilitation of the remittances. So facilitation is different than from transaction in money of borrowing and lendings. Similarly, there is another vertical. We have some banks having a credit card verticals where credit card business is taken into a separate registration. For this, we get reference of section 25.2, 25.4 and rule 11. Here, what I have tried to just put across is how a separate vertical, in case of banking, how the activities can be classified in another way, vertical, based upon the scenarios. Service mode, in case of banks, there is a physical visit of the customers required. In case of maybe separate vertical like digital banking, it can be online through mobile apps, etc. Cost per transaction in case of normal banking is higher. In case of vertical banking, it is separate, it is lesser. Accessibility is 24 by 7. It is only during the bank, during the
Excuse me, sir.
yes.
Sorry to disturb you in between. Actually, PPT is not moving.
No, I can see this PPT just now. This is page number 61.
Yeah, but on screen, it is just a page number 8. PPT number 8.
Oh, madam, then what can I do now? Should I again do it once more?
Yes, please share it.
Yeah, I'll just do it. Just a minute. Madam, is it visible now?
Yeah, it's 61. Yeah.
Okay. So, as far as the accessibility is concerned, the branch transactions can take place in a time-bound manner, that is on the working days, etc. As far as separate vertical, it's 24 by 7. Revenue model in case of main banking is mostly interest. In case of vertical banking, it is fees, commission, trading incomes, etc. Speed is slow, manual. Here it is instant because it is online. Compliances are normal traditional banking norms and compliances of RBI, etc. Whereas separate verticals, it is mostly on the cyber security and other regulatory norms. Then why there is a need for separate registration? As I said, that separate activities classified can qualify for separate registration because it helps to identify the profitability of that activity, of that of that vertical, and then accordingly the bank can enhance the scope of activities in that particular vertical. Generally, when a new business or a new line of activity is started by the bank generally does it in a form of a branch, or they establish a separate branch for that, and the branch gets a sole ID, and also it gets a recognition from RBI about that particular activity. So that itself says that it is an activity which is different from the other banking activities. Section 25.2, as I said, that prior to 1st of February 2019, we had this business vertical concept, which says that separate registration for each business vertical can be obtained. After 1st February 2019, there is an amendment to the law. Section 25.2 came into picture. It talks about a place of business. So a separate activity in a separate place of business can qualify for a separate registration. Only thing is that why a separate registration when already it is under banking? The main reason for this is under banking, what happens is that, as I said, my rule 38 allows me to claim ITC as per section 17.4 to the extent of 50%. But if I take a separate registration and I get this registration registered under the business vertical format, I can claim ITC under the provisions of 17.2, which talks about pro rata claim. Now, what is pro rata and what is 50%? As I said, in my banking, majority of my income comes from interest. About 90 to 95% of the income is interest income. So here I am allowed to claim 50%. So it is good for the banks that they are allowed to claim 50% ITC when they have only 5 to 10% of taxable income. But as far as the business vertical is concerned, if in a business vertical they have a taxable income or the component of the taxable income is more than 50%, right? It is absolutely more because trading incomes, your digital banking incomes, they are all taxable income, and there is a very small percentage of interest or exempt income involved in these kind of activities. So here, if my taxable income is about 90-95%, then I can claim ITC to the extent of 90-95%. I may not be restricted to the claim of 50% as envisaged under Section 17(4). That is why more and more banks are going into a separate registration or a business vertical format and claiming the benefit of ITC. Now, this claim is supported by the provisions of Section 17(2) as well as read with Rule 11, because you can have a separate registration for each place of business subject to conditions, and the conditions are specified under Rule 11. Rule 11 says that a separate registration may be permitted to each place of business for you have to follow only these three conditions. Entity has multiple places of business, yes. Composition scheme is restricted. So if I'm under a composition scheme, I cannot go for this separate registration. And interbranch supplies must be taxed and invoiced. Yes, in case of interbranch supplies, if it is a distinct person and if it is going to render supply to any other GST of the bank, then it has to be taxed and invoiced. Only these three conditions are there. If these three conditions are satisfied, then there is no further restriction for taking a separate registration and following the 17(2) route of claim of ITC. Output tax implications in interbranch transactions. So here, as far as branches within the banks are concerned, branches of the bank in one state and branches of the bank in other states are concerned, branches of the bank in India and branches of the bank outside India are concerned. These are transactions on the outward side. Similarly, suppliers of the bank within the state, suppliers of the bank outside the state, supplier of the bank outside India are concerned. This picture gives you a small idea about what should be the tax that should be levied on the transactions on the input and the output side. There can also be transaction between the bank units of the same state also. Now, if the bank has a single registration and the branches are added as additional places of business, then there may not be a separate billing to that extent because it is already covered under the same registration. Now here we come into the concept of this distinct person, because when I say of a bank having branches in one state and a bank having branches in another state, we need to know what is a distinct person. A person with the same PAN in two different states can be considered as a distinct person. A person, so here's 25(4) of the GST Act provides that a person who has obtained or is required to obtain more than one registration, whether in one state or union territory or more than one state or union, shall be in respect of such every registration be considered as a distinct person. So transaction between two units of two different states happens to be a transaction between distinct person. Interbranch transactions. Interbranch transactions can be between the branches of the same state, branches of another state, or between two verticals of because the word uses same PAN. So even a distinct person can also constitute a vertical in this sense. I will be dealing with this in inputs service distributor later on, because there it is dealt more in more of the detail. Why I'm talking of this interbranch transaction is that there is a circular which is given by the CBSE, Circular 199. Now this is specifically on the topic of interbranch transaction. Why I have chosen this interbranch transactions as a part of deliberation today is that I receive a lot of queries from various auditors. They ask me this question that a bank who is having, who is registered, I'm just taking an example, a bank who is registered in Mumbai and having the head office in Mumbai, they own a premises in Gujarat. Maybe say we talk Rajkot, and whether it is, and in many of the banks we see that the assets are recorded at the head office level in the books of the head office. So whether it is the state of Maharashtra providing services to the state of Gujarat, and whether invoicing needs to be done and tax needs to be discharged, I have faced this question many times from various auditors. Now here the important part is that if a premises is procured in the state of Gujarat, then in that case, an agreement was entered in the state of Gujarat. The agreement was registered in the state of Gujarat. The stamp duty was paid in the state of Gujarat. Land happens to be a state subject. It cannot be moved from one subject in one state to another state. So technically, the asset or the office should have been recorded in the books of Gujarat only, not in the books of Maharashtra. It can also be, a view can also be taken that the state of Maharashtra has lent money to the state of Gujarat for procuring the property. Another important part here is property is a location based service. It cannot move. Wherever the property is located, the tax has to be paid accordingly as CGST and SGST only. Now, considering all these things, even if the asset is recorded in the books of Maharashtra, still there cannot be a supply from the state of Maharashtra to the state of Gujarat, because the property is registered itself in the state of Gujarat. It is lying in the state of Gujarat. It is only that it has been recorded in the books in the state. There is no supply. At the most, there can be a transaction in money, which is definitely outside the purview of tax, and it meant, and a cross charge or a billing may not be required for this instant. Because if we do a cross charge or a billing, what will happen? That we will pay tax in the state of Maharashtra. But as far as Proviso 2 to Section 17(4) is concerned, the other state is going to get 100% ITC for the same. So as such, there is no revenue loss. But yes, there is an administrative hassle of doing all the compliances, transactions, and all those things. Now, exactly on this point, the CBIC has come up with this circular 199. This is on three parts. First part is whether the HO can avail ITC in respect of common input services. We see normally that invoice is given by the service provider. The services are provided both to the HO and to the branches. The branches may be in the same state, or the branches may be in the different state. So whether that one particular invoice which is issued to the HO, can the HO claim ITC thereof? So the answer given to this question in the circular was HO has an option to distribute the ITC in respect of such common input tax services by following the ISD mechanism. However, it is not mandatory at present. Now, when this circular was given in 2023, ISD was not mandatory. But this circular was very important because the GST department was asking the banks to compulsorily follow the ISD mechanism when the law never stipulated that to be compulsory. So this circular clarified it abundantly, saying that it is not mandatory at present. However, the HO can issue tax invoices under Section 31 of the CGST Act to the concerned BOs in respect of common input service. Conditions for distribution of GST under ISD to be fulfilled as per Section 2021. 73. Okay. So the second is the second issue that was raised in this circular 199 was it was in respect of internally generated services. There may be a case where the HO is providing certain services to the BO for which full input tax credit is available to the concerned BOs. However, HO may not be issuing tax invoices to the concerned BOs with respect to such services, or the HO may not be including certain portion of the cost, etc., particularly salary in that invoices. Here also the CBIC made it very clear that the value of supply is determined as per section 28 read with rule 28 read with rule 15.4, and here it says that as per clause A of Rule 28, the value of supply of goods or services or both between distinct persons shall be the open market value. Second proviso to Rule 28 of the CGST rules provides that where a recipient is eligible for full input tax credit, the value declared in the invoice shall be deemed to be the open market value. So here in case of banks where the states are having the same PAN number, they are distinct person, and any transactions between them, the recipient is eligible for 100% ITC as per proviso 2 to 17.4. Then whatever is the value declared in the invoice will be deemed to be the open market value. Tomorrow, if I say it is rupee 1, then rupee 1 is an open market value. If I say it is 0, nil, then even then it is a open market value. So here when the condition is full ITC to the recipient, the invoice value shall be deemed to be the open market value, and actual valuation is not required here. Issue number 3 discussed in the circular was in respect of internally generated services provided by the HO to the BO in case full input tax credit is not available to the concerned BO. In the first case, it was full input tax credit. Now it is full input tax credit not available to the BOs, and whether the cost of employees, etc., whether it is included or to be mandatorily required, the same thing. Here also the CBIC has clarified in respect of internally generated services provided by the HOs to the BO, the cost of salary of employee of the HO involved in providing the same state services to the BOs is not mandatorily required to be included while computing the taxable value, even though where full input tax credit is not. So now CBIC has abundantly made it clear that it is not required that the invoices between the HOs and the BOs, okay, be issued at the value as provided under section 15. So this is what is abundantly made clear by the CBIC. So here I have just taken one small instance. This is out of the FAQ. Will the bank be charged in transactions where loan of one bank is taken over by another bank? GST will be chargeable only transaction or processing fees if levied by the taking over bank. Otherwise, it is a transaction in money and there will be no liability to pay GST on takeover of loan by other banks. So these are also some of the aspects from the FAQs relating to RBI services provided by banks to RBI, then whether the income earned on repos and reverse repos interest is taxable. Being interest, it is not taxable at all, so no liability to pay GST on such transactions. So this is a case of where the supply of gold metal to a jeweler will be deemed to take place at a time of delivery of, because this is a very peculiar nature of business in the banking sector. Under the gold metal loan scheme approved by the Reserve Bank of India, it's a means of financing. The bank delivers the gold metal to the jeweler who appropriates and uses the same in the course of their business. The gold metal is seldom returned to, and the jeweler fixes the price of the gold within stipulated 180 to 270 days. So here what happens is the bank delivers the gold to the gold jeweler or to the jeweler, and then the price for that gold is fixed after 180 days to 270 days. Then when is the GST liable to be paid? Because this is a very peculiar question which happens with the bullion branches. Considering the nature of the transaction, generally what happens in case of goods is that the invoice has to be prepared upon delivery. So if the invoice is prepared, the value is written, the tax also has to be paid. Now, how can a bank wait for 180 days or up to 270 days in order to make the invoice? So here, what is stipulated is that invoice has to be made at the time of delivery based upon the rate applicable of that day. Upon the dawn of 180 to 270 days, whatever is the price that is finally fixed by the jewelers, bank can raise a debit note or credit note for adjusting the differential and pay the tax accordingly. So this is a practical suggestion that I pay the tax as of the value ascertained today, and upon fixing of the price by the jeweler, because here the jeweler is supposed to fix the price, upon fixing of the price by the jeweler on a later date, whatever is the differential may be paid out or may be adjusted by way of a debit credit note by the bank. We come to the concept of related parties. These are the list of related parties that are applicable in case of a banking scenario. More important here is the transactions between employer-employees, transactions between the directors and the banks, family members, etc. So what are the types of these transactions? Generally, processing fee, checkbook charges, NEFT charges, locker rents, DD charges, or some kind of lower rate in loans, etc., which is generally provided to the employer. So why these related party transactions are important is that if the transaction is not happening at an open market value of the supply, or it is happening at a concessional rate, the bank needs to pay tax on the variation or on the difference between the concessional rate and the open market value of that transaction. So bank needs to pay a discharge GST. So here it is important to ascertain whether all the related party transactions undertaken by the bank are valued and GST has been discharged by the bank account. These are the transactions generally where the bank gives concession to its employees, to its directors, etc. In these transactions, the open market value needs to be identified, the concessional value needs to be compared, differential may be identified, and whether tax has been discharged on that or not has to be seen. So if I say that in a financial in case of the GST assessment of a bank, the liability that the bank pays in its GST return cannot be compared and cannot be ascertained from the financial statement. Here in the financial statements, about 5% of the income, just as an example, 95% happens to be interest, 5% is a taxable income of a bank. Now, in order to identify this 5% of the income, we can say that 2% of the income can be identified from the profit and loss account. 2% of the income can be identified because this 5% income has gone in the GST return. Now I am reconciling. How do I find this 5% income? 2% I ascertain from the profit and loss account. 2% I am ascertaining it from the balance sheet. From where do I ascertain that 1%? That 1% can be ascertained through such kind of transactions of valuation, where valuation takes place. For example, my foreign currency transaction, foreign currency conversion tax transactions, their valuation takes place, Rule 32.5, proviso to Rule 32.5. Then in case of reimbursements, valuation takes place, because many times what happens in case of reimbursement is that the expenditure accounts are credited with incomes, or the income accounts are credited with expenses. So one needs to actually identify what is the nature of that credit, whether that credit amounts to a taxable supply, whether that credit amounts to a reimbursement, and whether the bank has discharged the proper tax on such amounts. Then we have this related party transactions, where one actually needs to ascertain what are the related party transactions, what is the nature of transaction involved in this, because there may be a related party to whom a concessional rate of interest may be granted, but interest per se is not taxable, so that concessional rate of interest also is not taxable. But if a concession is granted in the processing fee of a particular loan, for a regular customer, it is 10,000 rupees, and for an employee of the bank, it is 0 rupees, or it is say 1,000 rupees. Then 9,000 rupees of concession given to the employee needs to be calculated and seen that whether the tax has been discharged or not. Now, these transactions never come to the financial statements. These are all transactions which happen between, these are all related party transactions, and these are all valuation based transactions, and needs to be identified, ascertained for the discharge and calculation of taxes. So here I have just provided those valuation rules, etc., liable to the related parties, etc., that we can just skip. Now coming to the reverse charge liability. Now this reverse charge happens to be a very, very important part in case of banks, because lot many transactions which are, or rather lot many expenses which are happening in the banks are covered under reverse charge, and there is a lot of litigation happening on this aspect of reverse charge from the departmental side. So what I have tried to do is I have reproduced the provisions of 93, 94, 95, all these three sections, and notifications pertaining to that can be read later on. Now coming to the important points of a reverse charge mechanism applicable to the bank. So what I have done is I have identified the categories where reverse charge is applicable in case of a banking sector. Goods transport by road services, yes, RCM is applicable. A recipient can be a society or it can be a body corporate, both. Why I'm categorically saying society or a cooperative society, because a lot of cooperative banks are also a part of this. They also are coming under the RBI audits, etc. So the liability pertaining to RCM is applicable on the goods transport by road services. Then we have renting of motor vehicles designed with where fuel cost is included, then insurance agent services, sponsorship services. So here, any person, here the supplier of service, any person other than body corporate and service recipient. So if a sponsorship is given by a company, LLP or a firm to any person other than body corporate, then the company or the LLP or the firm will have to pay GST under the RCM concept. Here, LLP is also considered as a body corporate. Under the LLP Act, it is also considered because basically the definition of body corporate excludes cooperative society. So that is why I made this point clear that this sponsorship will not be applicable in case of cooperative societies. It will be applicable only if it is a firm, LLP or a company. Services by an arbitral tribunal, import of services. Any service provided by a person outside India under import of services will be liable for GST under RCM. Legal services, supplier of goods, individual or individual firms to any. So even if it is provided to a cooperative society or a cooperative bank, it will be liable to tax. All services provided by government or local authorities to any business entity. So bank being a business entity, it will be liable to pay tax under RCM. Services supplied by individual direct selling agents. So here, if the direct selling agent is an individual HUF or a proprietor, and the services of selling the bank's products are given to a bank or a non-banking financial company, the bank or the non-banking financial company will have to pay GST under RCM. Similarly, services provided by an agent of a BC to BC, then the BC will require to provide tax to pay GST under RCM. Recovery agent services, any recovery agent providing it to a banking or a financial company, the banking financial company will be required to pay GST under RCM. Services provided by directors. Services provided by directors. If the director is an individual and providing services to company or a body corporate, then the company or the body corporate will be liable to pay GST. Here, a cooperative bank doesn't fit into the definition of a company or a body corporate, and hence the services provided by directors to a cooperative bank will not come under RCM. It may, if the director is liable to pay GST, he may charge it under the FCM, that is a forward charge mechanism. Services provided by bank business facilitator to a banking company located in the taxable territory. These are all new concept, BC, BF, etc., where the banks deploy these people in order to increase their business, and there the liability under GST under RCM is attracted. Let us go further because we have got important things coming up ahead. Now, these are all some queries, questions that have been raised from time to time and addressed under various advanced ruling authorities, etc., pertaining to the liability to pay GST on the banking companies. Here, in this case, whether the salary paid to directors is liable under reverse charge. We have this classic judgment of Clay Card, which clearly says that if the director is an employee of a bank, that means he is a whole-time director, there is a PF, PT, etc. deduction. His salary also is deducted. The TDS pertaining to the remuneration paid to the director is deducted under 192. Then in that case, it will not, because it comes under the contract of employment, and services rendered by the employee to the employer are outside the purview of GST, and hence there will be no liability to pay GST. Other services rendered by the directors to the bank are liable for GST under RCM, excluding the cooperative banks. We go further. This is the concept of PSSE, that is the private sector, the PSLC transactions here will be priority sector lending certificates. These transactions are liable to be taxed under RCM from 28/5/2018. Earlier, they were liable to be taxed under FCM. As per Circular 193, IGST will be paid on the PSLC transactions. Now, these are certain questions. I'll skip that. Can be read later on. Now here I will be taking some issues pertaining to RCM, which are generally faced by the banks in case of their audits. RCM, why mark transactions to be scrutinized? What happens is that generally banks record all their expenses in their books upon payments, because generally bank follows the payment system of accounting. Even though we say that it is mercantile system, as on 31st March, all the transactions are entered on the mercantile system, but basically on the regular day-to-day basis, the bank follows the payment system. So once the payment is made by a bank, then the invoice is recorded in the system, or before making the payment, the invoice is recorded. Accordingly, tax deductions, etc. takes place. Whereas the actual invoice which is given by the service provider is uploaded on the GSTN portal by the end of at the end of the month within the next 11 days when the supplier files his GSTR1. So the supplier prepares an invoice, and on the 11th of the subsequent month uploads the invoice on the portal. Once the invoice is uploaded on the portal, it reflects in the 2A 2B of the bank. Now, having reflected in the 2A 2B of the bank, whether the bank is liable to pay GST on such expenses, generally the liability to pay GST under RCM arises on the 61st date from the date of the invoice. So then the liability arises in spite of the bank not paying that amount. Now take a situation where the bank has not made the payment towards the invoice on which RCM needs to be discharged, and it is reflecting in the 2A. So upon the exhaustion of 61st day, in spite of not being paid, the liability to, in spite of not being recorded in the books of the bank, the liability to pay RCM will arise. But before 61 days, even if it is recorded, even if it is reflected in the 2A, having not being paid by the bank, the liability cannot exist. But upon the payment, the liability has to be discharged immediately in the subsequent month. Now here what happens is that whenever a RCM transaction is uploaded by the supplier, he uploads this transaction and a RCM yes flag is raised by the supplier. That means that on this value which is uploaded in the which is reported in the invoice and uploaded by the supplier, the recipient needs to pay the tax. So what happens at the bank's end is that the GST department reads this flag and they insist that the bank needs to pay tax under RCM, and accordingly notices are issued. So here important aspect is that whether that 61 days criteria has been satisfied. Number two, whether that entry which is reported as RCM yes by the supplier actually is an entry on which RCM requires to be paid, because practically it is seen that the suppliers raise an invoice upon the banks. They charge GST in those invoices. Bank pays those invoices. Even the GST is paid to the supplier. But in turn, when the supplier reports that invoice in his GSTR1, he marks that RCM yes flag, and it is reported that the liability needs to be discharged under RCM, which is not correct. Many a times, what happens is the invoice that is reported by the supplier is of a higher value than the amount paid by the bank, because there may be some deficiency in services, there may be a higher statement of value in the invoices which the bank may ask the supplier to correct, or in case of deficiency in services the bank may not pay that entire amount. In such cases it is required, or the bank needs to insist the supplier to pass a credit note and amend the invoices suitably. So this was the notification 13/2017 which I was talking about. A body corporate has the same meaning as assigned to 211 of the Companies Act. However, it excludes the following, that is a cooperative society registered under any law relating to cooperative societies, and any other body corporate which the central government may by notification specify on this behalf, will not be included in the definition of body corporate. So wherever the word body corporate is used, we should be careful enough to see that it is not a cooperative society or a notified institution by the central government. Now, something very small pertaining to RCM liabilities on DTA branches involving inbound activities with overseas branches, etc. Because these things are very commonly seen nowadays in case of bank audits, that the bank transacts between SEZ units, DTA, that is the overseas units, etc. And the department raises various concerns pertaining to the applicability of GST. So many banks have their offices in SEZ. They are registered. Now we have the gift city also, because these are all exempted premises. And the exemption in case of gift city, etc., these are the exempted premises itself. Whenever they are transacting with SEZ units, etc., LUT compliances, etc., need to be done. Similarly, many of the banks make overseas payments pertaining to third-party vendors for services such as SWIFT charges, foreign bank charges, training services, software charges, visa fees, MasterCard charges, so many and so forth. So here the payments made outside India are in relation to services imported in India, because the supplier of the services is located outside India, the recipient being the bank located in India, and the place of supply is in India. Here, all the conditions of import of services are classified, because we are receiving services in India and the bank in India is making payment outside. So this is a classic example of a situation which is covered under the scenario of RCM, and reverse charge needs to be paid for payments. That is, GST needs to be discharged under reverse charge for payments made for SWIFT charges, foreign bank charges, etc. Now, of course, foreign bank charges, there have been a lot of judgments which says that banks are acting as intermediary, but other kind of services which the banks take from other foreign banks, there, of course, if it is not acting in the capacity of an intermediary, then yes, GST needs to be discharged under the RCM ambit. Now, these are certain slides pertaining to the input tax credit mechanisms, etc. I will not be dealing this in detail, just highlighting on the important aspects. This is for tax eligibility 16.2, the conditions for taking ITC under section 16.2, valid invoice, payments, receipt of goods, all those things I have, filing of returns, etc. that I have specified. 16.4, same. I'll come directly to 17. Okay, this is a newly added section. This is relating to the suppliers whose registration has been invoked and ITC was denied. So this is a newly added section which says that if the cancellation or if the supplier's registration is cancelled and subsequently revoked, and within 30 days if he files all his returns, etc., then the ITC credit can be taken. In normal situation, what happens is the ITC credit can be taken not beyond 30th of November of the subsequent year. So if a supplier has rendered services, he has given an invoice, and subsequently his registration gets cancelled, then the ITC cannot be claimed, because that since his registration is cancelled, he has not deposited the tax with the government, so the condition is infringed, and accordingly the credit is denied. But subsequently, if he settles his registration and the registration stands reinstated, and if he files his returns within 30 days, then the ITC credit can be allowed. So this is the section which allows the credit of ITC. 17, section 17, section 17.2 and 17.4 are more important to be discussed. Section 17.2 deals with ITC, deals with entities which have both exempt income and taxable income, and the rule applicable for their reversal is 42, 43. 42 is for my normal ITC, that is the revenue items. 43 is for my capital goods. Here the fundamental is that the bank which follows the 17.2 procedure can take pro rata ITC or proportionate ITC. So that means they have to reverse the ITC that is attributable to the exempt portion. Whereas those banks which follow the 17.4 criteria of claim of ITC, they are eligible to take 50% of the ITC, and the balance has to be reversed. There is a proviso 2 to section 17.4 which talks about ITC received from the same PAN, that is distinct person. Banks are eligible to claim 100% ITC. In case of 17.4, my rule 38 applies for the which prescribes the mode of reversals, etc. In case of proviso 2 to 17.4, 100% ITC can be claimed in case of distinct person transactions. So this is the same thing. I will not repeat here again. Okay. Blocked ITC. Now, in case of banks, generally blocked ITC, ITCs pertaining to vehicles, rent-a-cab, etc., not allowed. Transportation of goods, passengers, motor vehicle ITCs are not allowed in case of banks. Then ITCs pertaining to food and beverages, outdoor catering, beauty treatment, health services not allowed. Membership and club and fitness center not allowed. Rent a cab, insurance, life insurance, health insurance not allowed. Travel benefits extended to employees on vacation, such as leave or home travel concessions, ITC is not allowed for the banks. So these are the aspects of 17.5 applicable to normal banking institutions. Similarly, works contract, construction of any kind of ITC which goes into a property, construction of immovable property, not allowed for the purpose of claim. Similarly, supplies on which tax has been paid on composition scheme, because the composition dealer himself pays on its own. He never recovers it. So once we have not paid that, no ITC will be allowed. Any kind of supplies which are used for personal consumption, no ITC allowed. Goods lost, stolen, destroyed, written off, or disposed of by way of gift or free samples, ITC not allowed. Now, why I have been taking this aspects of ITC 17.5 block ITC is that lot many banks face a lot of litigations or demands from the GST department pertaining to the ascertainment of eligibility of the ITC. So these are those aspects where the banks face problems, that because what happens is in my 2A or 2B, the entries that are reflected is qua the GSTN and the name of the supplier or the trade name of the supplier which appears in the certificate. Now from the GSTN or from the name, it is very difficult for the department to ascertain that whether the nature of supply is taxable or exempt or blocked. Why I'm saying so is that when the entry is reflected in my 2A 2B, the department understands from the HSN used. Now department identifies from the name and from the name or the description of the service. Now for example, if it is a hotel, if it is an hotel and a bank has booked an hotel for its auditors, now the name will appear in my 2A as so and so hotel. Now does that mean that the name so and so hotel will signify that the hotel has sold food and beverages to me? It is not so. So it is the HSN which is important to be understood in order to identify the nature of service involved. Because whenever that name hotel comes, department says that it is for personal use, it is for food and beverages, and hence it should be disallowed. But here, how we can explain the department in the audit procedure is that please ascertain the HSN use, because the HSN for food and beverages is different, and SSC, it is not HSN. SSC for food and beverages is different, and SSC for accommodation is different. If the SSC use is for accommodation, then accommodation doesn't happen to be a service of blocked nature. So if the auditor of the bank stays in a hotel for the purpose of the audit of the bank, then in that case, such input tax credit must be allowed to that particular branch or that particular state where the bank is registered. Similarly, the claim of ITC pertaining to travel expenses by bank, we see many times that a lot of payment is made to railways, it is made to airways, that is the flight tickets, etc., where the claim of ITC is reflected in 2A 2B. Department's stand is that these expenses are in the personal nature of the employees. It is important to explain the department that any kind of personal expenses on travel, leave travel concessions or personal nature generally are booked by the bank under different codes. They are not booked under the codes which are eligible for ITC. Another thing is that the employee of a bank doesn't travel for leisure. He travels for the work of the bank. He travels for the business of the bank, and the expenditure incurred is in course of furtherance of business. Wherever the employee travels on his own account or for leisure, such expenses are booked separately by the bank, and such credits are ineligible credit. Whereas the travel expenses incurred by the employees, by the board, by the consultants, professionals, auditors are all in course of furtherance of business, and the credit thereof needs to be available to the bank. Claim of ITC pertaining to bottled drinking water provided to customers. Here they say that it is personal consumption. There is no personal consumption because it is a customer, and they say that it is a beverage. Bottled water is not a beverage. So ITC claim pertaining to such expenses, to my understanding, should be eligible for the banks. Claim of ITC pertaining to renovation expenses. Again, any kind of renovation which is in the nature of immovable property affixed to the premises, such renovation expenses will not be available. Any kind of movable renovation expenses, repairs and maintenance will be available to the bank. Claim pertaining to gifts to customers and members. This matter needs to be verified on the practical aspects and on the basis of the facts. It should not be in the course of sales promotions or something like that, which is a bar under 17.5. Otherwise, it will be available. Claim of ITC on CSR, already it's a discussed topic that it will not be available. There has been a circular to that extent. Key points to be remembered pertaining to ITC. Because ITC happens to be a very important and a delicate aspect in every bank. So these are certain pointers that I have tried to identify that a bank needs to verify on a regular basis before making claims, and auditors may assess the claims made on this basis when they are doing the auditing of the banks. Awareness to the branches regarding checking of the GST, because in case of claim of GST, now it is very simple. Earlier, it was not so that now the ITC appears in my 2A, 2B. Earlier, there were lots of issues pertaining to these things. Now, because of IMS, etc., screening has been done on a regular basis. But yes, for earlier years, still these issues are going on. And wherever the ITC claims are not available, the CBIC has issued circulars. They are asking for certification, etc., in order to ensure that the banks or the recipients get the claim of ITC. Here it is important that in case of invoice, what needs to be checked is the GST number in the invoice, the name of the service provider, the name of the service recipient, the address of the provider, address of the recipient, invoice number, the date, the SSE or the HSN classification, rate, value, and the tax levied thereon. All these aspects are to be examined minutely by the bank on a regular basis and by the auditors at the time of claim of ITC. Here, important thing is that the suppliers who are supplying services to the banks needs to be verified or examined on a periodic basis to identify whether they are blacklisted, cancelled, etc. Because of that, maybe the claim of ITC may go in dispute, and the bank may have to face the losses. No doubt, the judiciary has come up with lot of positive judgments in this case. They say that the supplier should not be put, the recipient should not be put to the loss for the mistake of the supplier if the transaction is bona fide, care has been properly taken, and the conditions are fulfilled by the conditions are fulfilled by the in the transaction. In case the supplier has not deposited the tax, the department needs to go to the supplier and recover it. They cannot just ask the recipient to reverse the ITC. Another aspect to this, or a second facet to it, is that the tax is levied and collected as per the rate stipulated. Now, if that tax is not deposited by the supplier to the government, the recipient is required to reverse the tax and pay the tax. Here, the recipient has already paid the tax to the supplier, and asking him to pay the tax again by reversing to the government will amount to a double taxation on the recipient. Article 265 of the Constitution clearly says that tax can be collected only with the authority of the law. Coming to know that the supplier has not deposited the tax, the government will go after the supplier and recover the money from him. So asking the recipient to pay the tax once and supplementarily going to the supplier and recovering tax from him, it means that on the same transaction tax has been collected twice. Now, to whom is the government going to refund? So government cannot say that whether they are going to refund it to the supplier or they are going to refund it to the recipient. So this will amount to collection of double taxes, and hence it is never the intention of the law to collect the tax as stipulated in the Article 265, and hence the courts have been kind enough to allow this benefit that the recipient need not be asked to pay the tax unless and until the supplier has been pursued by the of government offices. So here are some reporting and reconciliation aspects in the banking sector. Earlier, as I said, that the banks were claiming the benefit of ITC only upon payment, because upon the payment of the invoice was getting recorded. After the invoice was getting recorded, as per section 36, the reconciliation is to take place, and once the entries in the books match with the entries in the 2A 2B, the bank would be claiming their ITC. So earlier, only to the extent of the match entries, banks were claiming ITC. This entire procedure changed since October of 2022. The department said that in the reflection in the returns itself, they changed the reflection of the ITC. They said that you have to claim the entire ITC available in the 2A 2B in the GSTR 3B returns. Then whatever is matched may continue, and whatever remain unmatched may be reversed temporarily and carried forward to the next month for the purposes of reconciliation. Once it is reconciled, it may be reclaimed. It may be reclaimed, and whatever remains unreconciled may still remain in temporary reversal and may be taken to a subsequent period. So this entire mechanism of claim of ITC in 3B changed since October of 2022. So what I have done is that this is the procedure of reporting this change methodology of claim of ITC. I will not go through this because this can be read and understood. Coming to the important aspect of input service distribution, which has become mandatory from 1st of April 2025. As you saw in the circular 199, prior to 1/4/2025, this was not at all mandatory. From 1/4/2025, the government said that input service distribution happens to be a mandatory requirement for transfer of input service tax. So input service distributor is an office of a supplier of goods or services or both, which receive tax invoices towards the receipt of input services. So ISD mechanism is only applicable to the services, including services in the nature of those RCM, etc. So what is covered under ISD is are only services. So goods are not covered under ISD concept. So distribution of common credits has become mandatory. So whatever are the common credits, the invoices of which are received by the ISD registered entity, and that is responsible for distribution of credit to the other constituents of the institution. Recipient of common input tax credit shall have to be mandatorily registered under the ISD. Common credit shall be distributed to distinct persons as per section 25 of the Act. ISD shall also be applicable to services covered under reverse charge and will require changes in the record keeping. So in order to improvise ISD, a lot of changes were required to be made by the bank in their banking software, etc. So things to be considered: whether ISD distributor has correctly bifurcated. So when the ISD receives the input tax invoices, they have to identify what are eligible invoices for distribution, what are ineligible invoices for distribution in terms of 17.5. ITC transfer to ISD can be tallied with the trial balance of the head office to ensure that the ITC has been correct. So whatever ITC is received, that needs to be transferred to the distinct person, and further it needs to be verified whether the recipient of ISD has correctly reversed, because the recipient needs to reverse the input tax credit under section 17.4. That 15% reversal is done at the recipient's end, that is at the branch end or the state end, wherever whosoever is the distinct person. Here important part in ISD is that key number one, key if I have got common inputs, they need to be transferred to the recipients or the states in the proportion of revenue. So if a bank has got offices in 10 states, and then in that case we have to consolidate the entire revenue of those 10 states, taxable as well as exempt, and we have to pro rata identify the revenue of that state upon the total state, and the ratio has to be applied for the distribution. So that is the way the distribution has to be carried out under ISD. Now, these are the returns and compliances that needs to be followed by the bank. GSTR 1 3B on 11th of the next month, and 20th. One is on 11th, and 20, and GSTR 3B is on 20th. One gives the report of the output, whereas GSTR 3B talks about the liability to be paid. In GSTR 3B, we also discharge a liability towards the RCM. Similarly, those government entities or government banks where in whose case TDS is applicable, deduction of TDS, the returns are to be filed in Form GSTR 7 and up to the 10th of the next month. Input service distribution returns GSTR 6 for to be filed by 13th of the next month. Annual returns 9 and 9C 31st December of the subsequent financial year. So these are the interest, late fees, penalties that may be applicable to any institution for filing, doing a late filing of returns, etc. Now, madam, how much time do I have now?
Session is up to 5, so we have few questions.
Yeah, no, madam, these are some common issues. I will be just touching upon them. So maybe 5-7 minutes more.
Sure. Yes.
Yeah. So common issues faced by bank. These are all issues which have come out of audits, etc. of bank. Whether the premium which is charged on supply of gold, whether that happens to be a separate supply and on which 18% tax has to be deducted. Answer is no. It is a part of the value of the. It is integral to the value of the gold. No buyer takes or buys these services separately. It is a part of the value. It is an intrinsic part, and hence whatever is the rate which is applicable on that particular bullion will be applicable on premium itself. Then GST and the RCM to be paid on inclusion of gold imports. Similarly, here also the premium paid by the foreign banks treated as import of services. Here it cannot be treated as so because it is a part of the value imported and no separate tax needs to be paid on the import of services. Then department issues notices to bank demanding tax liabilities on following grounds. RCM liability seen in GSTR to be on ad hoc basis without taking into consideration whether the transaction pertains to bank or not, or whether the vendor is a registered vendor for the bank. Disallowing input tax credit, I think I have dealt with this. Okay, here there is one important part relating to ISD. This is a very recent Madras High Court judgment in case of Reliance Jio Infochem, which held that ITC distribution cannot be strictly linked to a month of the invoice, because this was what earlier mandated in the ISD regime, that whatever invoices are there in that month needs to be distributed. Whereas the court observed that unless and until the invoice is recorded in the books of the bank, it cannot be distributed. Hence, there is no mandate for that. FCM transactions wrongly reported, we have covered that. Yes, a department issuing notices alleging short reversal of input tax credit by applying 4243. Actually, section 4243 is not applicable. Banks are mostly following 17.4 of 50% reversal. So that the observation given by the department in many of the cases is wrong. Department has observed bank has applied 42 reversal of digital banking operations, and on this basis has alleged that bank is not following. Here the issue is conversely different. Here in case of vertical registration, because the bank is following 17.2, that is pro rata reversal, the department is alleging that, oh, since you are a part of main banking and the main banking is following 17.4, you also follow that 17.4 and you are not supposed to reverse under 42.43. The observation of the department is absolutely wrong. The vertical is independently allowed to follow the methodology which it has adopted. Department cannot enforce that a 17.4 has to be followed when the bank is following 17.2. Banks have been also receiving notices pertaining to the 50% reversal that they are doing on capital asset being capitalized in the cost of the asset and depreciation being claimed. Here they say that since you are claiming depreciation, your entire input tax credit is disallowed. Also, this is a wrong proposition because the issue is that my 17.4 talks about after I claim that 50%, the rest shall lapse. Once the 50 balance 50% of the ITC has lapsed, it becomes a cost. If it becomes a cost and it is not an eligible portion henceforth or at all, then in that case, if what I do with that 50% cannot be challenged by the department, because if I transfer that lapsed 50% of ITC to my PL, my profit will come down. If my profit will come down, then I'll be paying less of income tax. Now I'm paying income tax at a rate of 30%. Whereas if I'm classifying that amount as a part of my value of asset, I will be claiming depreciation only to the extent of 10%. So I'm paying more profit here. I'm paying more tax here. So this is a point that can be explained, and this proposition can be challenged. Disallowance of credit if the same is not claimed by the bank. This is another thing that the department is contemplating, is that if you are not claiming the input tax credit in the same month, then it will lapse. The law never stipulates so that if I am not claimed the input tax credit in the same month, it lapses, because bank always follows the principle of matching on payment basis, and because always there will be a timing difference, then the claim will come on a later date itself, and hence we cannot accept the proposition made by the department that the ITC will lapse if not claimed in the same month. Similarly, here there is an allegation pertaining to the reimbursement of expenses made by the head office to the foreign branch as import of service. So any reimbursement or any payment made by the head office to a foreign branch cannot be in all cases be considered as import of services. The reason being that these expense, number one, we have to ascertain the nature of the foreign office or the foreign branch. If it is only a licensing branch, then in that case, licensing branch is never allowed to do any kind of business as per the RBI norms. So if it is a licensing branch, then what the bank is doing is funding for its own expenses. It is not rendering services to anybody outside, because that licensing branch never gets registered under the laws of that particular country, and hence it does not happens to be a separate entity or a separate person. Here in that case, many of the reimbursements are in form of rentals, reimbursement towards rentals, staff cost, welfare expenses, etc. Applying the settled principle of substance over form, the true nature of transaction must be considered. Mere accounting entries or fund transfers between establishments of same legal entity do not alter the characteristics of the transaction. Similarly, the department alleges reimbursement of expenses made by the HO to foreign branch. I sorry, this is repeated once again. So thank you very much for the patient hearing. Madam, I have concluded my part of presentation. I am open to take up the questions if any.
Sure, sir. Thank you for that practical and detailed session. Now we are moving to Q&A segment. We have few questions from participants. So I'm just asking the first question. Commission paid to pygmy agent will be having forward charge or RCM?
See, these pygmy agents, I think there is a notification by the government which gives certain exemptions also. So mostly, I think it will be, see, if these pygmy agents are for, they are collecting the deposits from the ground level or the lower level, right? Hello.
Yeah. Yes.
Yes. So see, we have this DS. If that pygmy agent is a DSA, then it will be covered under RCM. But I think for this pygmy agent, there is a notification for exemption. I will share that with you.
Okay. Okay, sir. Next question is RCM to be paid on purchase of priority sector lending certificate, PSLC, under which head? whether it is IGST or CGST.
IGST, I have given the reference of the circular also in the presentation, which says that it has been clarified and it has to be paid under IGST only. Because, madam, what happens in PSLC is that we never know from whom I am purchasing.
Okay.
So I don't know the location, na? So
Yeah.
that is why they clarified that it has to be paid under IGST only.
All right. One more question we have. So when a bank, be it a cooperative or other bank, auction pledged gold jewelry due to loan default, will it be sale or will it attract a GST? If yes, then what rate?
Madam, the issue here is that auction. Okay, when do I do an auction? When the assets are repossessed. Okay, so here I have given a loan on the security of gold. Now that person has not repaid the loan, so I have confiscated the gold because there my Surfacy Act etc. comes into picture, and because of which this happens to be a repossession transaction. So when it is repossessed, I have to do the valuation, and based on the valuation, I have to pay the tax if applicable, and it will be at the same rate of that particular material involved. So if it's a vehicle, it will be that way. If it's a machinery, it will be that rate. If it is gold, it will be at 3%.
Okay. All right, sir. Great. So as we come to the end of this insightful session, I would like to express my sincere gratitude to our esteemed speaker, CA Anand Desai sir, for sharing such a valuable and practical knowledge, to the GST and Indirect Tax Committee of ICAI for organizing this webinars, and all the participants for your active engagement and participation. We hope this session has added value to your professional journey. Thank you once again and wishing you all a great day ahead. Thank you, sir.
Thank you, madam. Thank you.
Tech team, you can
Recording stopped.